Hello, everybody. This is David Skrika. This is stock chart of the day. So today we have a very interesting chart in that we're going to be looking at what I believe is the only long-term investment that you have to really make. A lot of people see me as a doom and gloomer and a gold bug, but I've been huge on emerging markets in the past. India has probably been one of my favorite places to be. I made a lot of money in Tata Motors back in 2009. Was one of my best trades. I bought it right at the bottom. I think I sold it around the $20 to $25 area. It was 350 was the bottom. The stock didn't even trade, by the way, in the United States anymore. It's only Indian listed, which tells you something. Tata owns Land Rover and Jaguar, and Tata doesn't even need a U.S. listing anymore to attract capital because India is starting to get so big. And actually, I saw a recent stat that options trading in India is now it's the second largest country in the world to the United States. So they have liquid markets unlike China. They have real accounting unlike China. Because they kind of get that descendant from the British Commonwealth, using having a real legal system. But of course, there is still a lot of corruption and all that sort of thing in India. So you have to take that also with a grain of salt. But no, this is the India fund. There's other funds as well. This is the one that I like. Morgan Stanley is an India fund, et cetera, et cetera. So this is the one I like. It pays, you can see, nearly 9% a year right now. The last distribution was 43 cents. And I think what it does, it comes out of the gain, some of the gains for the fund get redistributed. That's why you'll see on one chart, which I think is the incorrect chart on Yahoo Finance, you see the stock's actually long-term down, but on the other chart, which we'll look at on stock charts, it's up because stock charts is adjusting for the fact that, that some of that those assets come out of the funds. You have to readjust the old price, right? So anyhow, so first of all, we'll look at the rupee. So the rupee has had this long-term decline. Many emerging market currencies look like this. You can see the rupee has actually declined more than 50% since 2008 and really 60% since 97. But what was interesting about the rupee is, of course, when it goes down, that's like the rupee rallying. And we can see that from about 2002 to 2008, about a 6-year period, when emerging markets really led the way, the rupee actually appreciated. It appreciated about 20% in value against the US dollar. So as now, I think we're going to enter another cycle where, because these debt problems that are in the West, really, India does have a national debt. Their government isn't exactly great at, they do spend, but because they're growing so quickly at 6 to 8% a year, they can run 4 to 5% deficits, because debt to GDP, when you're running a 5% deficit and you're growing at 6, actually is shrinking. So I would prefer their deficit to be smaller, but they have a little more leeway because they're still in that growth phase. So I think we could enter another period like here where the rupee actually appreciates against the US dollar after this is done. And you can see recently, even though the rupee has declined a little bit, it's actually held up pretty good considering the recent strength in the US dollar against the euro, the Canadian dollar, the other, kind of the emerged economies, you could call them, the other developed economies. So that's the one thing. But even despite that, the Indian stock market has really grown, even in US dollar terms, because and the economy has grown in US dollar terms because it's just growing so quickly. So this is the estimated growth rates, the growth of the last few years. You can see in COVID, it shrank like everything else. And then actually by post-COVID, India was one of the few countries that was already higher in GDP than it was pre-COVID, because it just rebounded so strongly and quickly. And then you can see, these estimates are all about around 6.3% for the next few years. Now, obviously, that's probably not going to happen. In the next 5 years, you're probably gonna have years that are higher or lower. And let's face it, if there is some kind of bust in the United States and the West, India will suffer a little bit, but I would expect it would also rebound quicker. There's a lot of investment going on in India. Apple is now actually starting to move a lot of production to India, et cetera. So the one investment I talk about is there's all kinds of good Indian funds you can buy, or Indian stocks. That will be more for paying members of Stock Chart of the Day. But the one I really like is the India fund. Now, this is an ETF, and this is one of these ETFs that came out way before ETFs became popular. You can see it came out back in 94, 95. And you can see it came out at just over about $1.50 a share. It declined during the Asian crisis, like most emerging markets, to about 60 cents a share. And since then, it's gone up nearly 30 times in value. And that's on top of all the, all the distributions. I mean, the distributions on top of that, So you can see it spiked over 2 during the dot-com bubble, came down about 60%, 70%, then spiked to 10 during the the housing boom and the emerging markets boom, went back to 3. And then we can see it kind of lagged like all emerging markets did, had another move down from 12 to just under 7 during the 2020 COVID crash, and now has moved quite significantly higher. So you can see during all these busts in the markets, this thing has dumped twice. It's dumped about 70% in the last 2 major bear markets. And then in 2020, it dumped nearly 50%. And it dumped actually nearly 40% during the 2011, 2012 period. So what I think with this longer term going forward is quite simply, we'll get a shorter term chart now. And of course, that really has outperformed the S&P. Maybe we'll go back longer term and show that in a second. But you can see one reason I haven't wanted to recommend this or talk about it is because we were on this huge run, like all equity markets were. But now we can see India really has kind of gotten smacked off nearly 15% on the India fund, where whatever the S&P's fallen 4 or 5%. So now I'm really starting to get interested in the India fund longer term. You can see some big volumes here recently too, but that's really not the point. If we do see, say, a 30% drawdown in the S&P, 30 to 40%, this would probably fall 60%. And you want to buy this, head over fist or fist over whatever the term is. I don't know, man. I'm sounding like Ricky for Trailer Park Boys. I can't remember my terms. So that's basically it. So now if we go look at, let's do the India fund divided by, the S&P 500, because everyone says, oh, you always want to be just in American stocks. America's got the most dynamic economy, et cetera, et cetera. Look at this huge outperformance. If we go below and we'll go price performance, and we'll divide again the India fund by the S&P since the mid 90s. Okay, there's going to be long periods like the last decade, the India fund underperformed, but you can see here the India fund divided by the S&P. So this is not even minus S&P. This is it's 50%. So that means, for example, the India fund in that same period, we'll go look at the actual percent returns on each. So the India fund, and we'll get the price performance of the S&P. So you can see the India fund up over 1,400%, the S&P up 900%. So you're up 500% more on the India fund. You're up basically almost 15 times on your money, and the S&P is up about 10 times. So that means that, $1,000 invested in the India fund would it be 15,000 now, and it'd be 10,000 the S&P. So of course, if you have big money, if you had 100,000, that really makes a difference, because 100,000 would be $1 million in the S&P, and it'd be whatever the India fund. Plus, I'm telling you, the India fund has huge distributions, over 10% a year, and that's another thing that's great about it. With it averaging, 7 to 10% a year in distributions on the India fund, it's like you don't even really have to make a lot of money on this thing, and you can just sit there and get your 7 to 10% a year. The S&P, especially compared to the rate of inflation right now and to the 10-year bond, the S&P has one of the lowest yields it's ever had in its history right now. So as well. And again, if we looked at the Indian fund like PDE ratio, 6 times earnings. The S&P, of course, is trading much higher. Now the Indian market is trading higher than that. So longer term, and then the demographics are good in India. Actually, they just passed China in terms of population, because the 1 child per family law in China really has hurt China's demographics. I showed you the growth rates. If we were to look at the China growth rate, you see China actually is growing under 5%. Remember all those years China used to be outgrowing India. Actually, when India was in the 6% range, China was 8 to 10%. That's come down. India's GDP per capita is much lower than China's. I think China's is 3 or 4 times the level. So India has a lot more room to grow to become basically the same standard of living China has now. India can grow 3 or 4 times from where it is today per person. So I think the dynamics are a lot better. Now, there's tough to do things in India. There's a lot of red tape. There's a lot of issues. But again, with this kind of growing population, they need economic growth, because if you get if you have a country that say ultimately is going to have 1.8 billion people and there's no work, you're going to have a lot of civil unrest. So I really like India longer term. I think this is like, as much as I love gold and silver, if you told me to make one investment over the next, I'm 46 years old. So hopefully I live into my mid 80s like my grandparents did. So if I can make one investment over that next 40-year period, it probably wouldn't be gold and silver. It'd probably be India, or let's say even 20-year period. It'd probably be, till like, retirement age, which is whatever, 66. It would probably be India. So that I just wanted to show you this. So the India fund is definitely something to have in your radar. It's something that, I've been waiting for a pullback. Well, I started looking at it last year again, and it was just like, you know what, this thing's not cheap enough. And I knew the history of it having these drawdowns, but definitely on any sort of drawdown. And remember, you're after the drawdown, your return is going to be greater than US stocks. So you can see if you would have bought, the India fund during the bear market in 01, 02, you were already up 3 times your money, by early 2004. You weren't up 3 times your money on the S&P, even buying at the lows in 01, 02. So I think this is a great way to play it. If we just type in India, I'll show you maybe we'll look at, yeah, let's look at this. This is Nifty 50. This is the 50 largest companies in India. Now you'll see this is up even more because, of course, this is priced in rupees. So let's just go back to 1993. And you can see, yeah, it's gone from 1,000. So you see, that's the devaluation in the rupee, right? This has gone from, actually, you can see nearly 500 in 1993 to 22,000 at the moment. So, but of course, adjusted for US dollars, it's nowhere as high. But again, you're up, you're up over 20 times in rupee terms, actually 40 times in rupee terms, because 20 times would actually be 10,000, and plus dividends. So even in US dollar terms, you are doing fantastically. So I think this is going to continue. But like I said, I think we also have to wait for these drawdowns, and they happen. Like I said, if you go look at, like, again, the early 2000s, they've happened 3 times in the last 24 years. They a very significant drawdown. That being 2020, 2008 and 2001. Because they get more with the bear market. So again, if this could drop to, I don't know, 10,000 on this move or 12,000 on this move, I think you definitely have to accumulate Indian stocks. And like I said, India has a lot of top tier companies, Infosys, Tata Motors. So they actually have a lot of top tier companies that are known around the world. Infosys, you probably, if you're calling in a call center and you hear an Indian voice, it's probably an Infosys call center. Like I said, you can buy your Jaguar or Land Rover from Tata. So, China's getting there now, because China, but China has a lot of tech companies. I think Huawei now is become a top tier tech company. It doesn't even trade. So, but the problem again with China is a suspect accounting, et cetera, et cetera. So this one to end off here. You can see the returns. Past returns do not indicate future performance. India is a little too expensive for my liking here. Like, again, let's go look at a shorter term chart. You'll see the Nifty 50 is barely even on. Look at this little blip here, right? So, but definitely I would think on any sort of correction. And look, you don't have to wait. You can start picking away. You can dollar cost average. Like in 2022, you never, if you were waiting for the 50% decline, it never happened. But India did go down 3,000 points, which is about 17, 18%. So I think that once it starts falling, in that, 15 to 20% range, you maybe do the first tranche. And maybe even if you just that kind of decline again and new highs, maybe that first tranche doesn't give you as large a position, but at least you're participating. And then you can kind of wait for the rest. And remember, when you dollar cost average, you get more units as things fall. The perfect example, let's go back to the India fund, is that if you start dollar cost averaging, let's say down 20%, say at $16. So let's say, just argument's sake, let's make it easy. Let's say you're doing $1,600 at 16. So you get 100 units, right? If you $1,600 at 10, you get 160 units. So that kind of helps your dollar cost average as it goes down. And that's why you can get it closer to the lower price, and you can decide to increase the amount, because you can say, okay, there's less risk because now this thing is much lower. So Anyhow, I just thought I'd point that out for you. And here's another thing, interesting thing, actually, I should point out about India. India leads to the upside in when markets bottom. So let's just quickly look back at this. We're going to look back at the early 2000s. Note that in 2002, when the Nasdaq and the S&P were hitting new lows, India was well above the 2001 low. Okay, let's go back to 2009, 2010. India, well, this did, but a lot of Indian stocks didn't. But when the Dow went below its 2008 low here, I bet you if I get the Nifty 50, we'll go back for that a second. Many Indian, I remember Tata held its lows. That's what I remember. But you can see India barely went through the lows. The Dow went significantly through the low. I think the Dow's low was like in the 800s or 900 range during. Let's actually S&P. Let's go look at the S&P just to see it. The S&P. You can see, look how much significantly lower the S&P went. Okay, actually it's 750, but on that spike low here, and then it went to 666. You can see from the India fund in that same time period, the India fund barely went below the low and then really shot up from its highs. Again, like when the S&P shot up from those lows, it went up 40% pretty quickly. The India fund, you can see, went from about 250 here to almost $7, nearly tripling in value in just a few months, right? So that's the kind of returns that you can get, on this, especially off the lows. And then, so I just wanted to show you that. So India usually leads out of these lows as well, when the market's kind of retesting and the whatnot. So, and actually, and here's another interesting, look at 2018, excuse me, as an example. In 2018, India, the Dow made a low and the S&P made a low in December. India actually bottomed in early November. So again, led the way out of that. So anyhow, I just wanted to show you this, and just to show you, I think this is the one investment, this is the tool I would use personally. For those interested in individual stocks, at some point on Stock Chart of the Day, I will talk about Indian equities. But I hope you enjoyed this. I know this is a little longer than our usual one, but I think because this is such a macro trend, like I could go on about India for years, about the growth. If you ever watched the movie Slumdog Millionaire, like when you watch it or read the book The White Tiger, actually, there's a great movie. They did a good movie of The White Tiger too. It really reminds you of kind of that Dickens era, of the books that he would write in the UK, of the Industrial Revolution, and everything's kind of dirty and raw, and but there's a huge amount of growth going on at the same time. So, that's kind of interesting. But anyhow, I just thought I'd leave this, and I just say, yeah, it's too early to buy in my opinion, but definitely, if you're looking to buy something and forget about it for 20 to 30 years, you're someone who just had a kid and want to pay for your kids' education. Again, not financial advice. This is never financial advice, but I think India is definitely the long-term growth vehicle.